Good afternoon. Welcome to Principles of Hotel Investments. For those of you that were here for the table, we're so glad you stayed. That was a really amazing event. And for those of you that are joining us now just for this event, thank you for coming. So I see there's still folks walking in. There's plenty of seats up front. I promise I won't call and pick on you, so feel free to come on up. So Principles of Hotel Investments, we could spend days talking about this, but we have 45 minutes. So we're gonna move fast. In the app, in the Hunter app, there is a handout with all of the acronyms, definitions, terms. It's a really helpful tool. So feel free to download that. If you don't have access to the app, get out a business card, write handout on it, and hand it to me at the end, and I'll email it to you. But it's a really great tool, so feel free to check that out. I'm Andrea Belfanti, the CEO of the International Society of Hospitality Consultants. Lucky for you, we have an amazing panel of experts because I could not do what they do. So we're going to jump right in. We're going to have them introduce themselves. And Aaron, I'm going to start with you.
All right, Aaron Anderson, CEO of the 26 Co. We're primarily a project development service firm. And we also own a few assets.
My name is J.R. Patel. I'm the President and Chief Operating Officer of Helix Hospitality and the founder of Pi Capital, our family office that sponsors our deals.
Good afternoon, everyone. My name is Kendra Plummer. I'm the founder and CEO of Elise Capital, which is a hotel investment firm. We currently have a portfolio of hotels within the Hilton and IHG brands.
I'm Chris Silke. I'm the COO of RevPAR International. We're a hospitality advisory and asset management firm, and I'm a proud member of the ISHC.
Thank you, Chris. Woo, I heard some woos out there. I didn't even pay for that. This is amazing. All right, so this is Principles. This is like a basic level, so we're going to start with some fun facts. All right, this is global hotel rooms. So raise your hand if you think the total number of global hotel rooms is 10.5 million. Nobody. All right, 17.5? I see one over here. All right, how many of you think it's 26.2? Okay, all right. The answer is, drum roll, 17.5. Sir, over there, you were timid, good job. That's right, you were the one. All right, what's interesting about this is that you can kind of see the progression. Estimates indicate that by the year 2050, we'll have 26.2 million global hotel rooms. That's a pretty amazing advancement there. All right, so I'm not gonna read all this. I think what's really interesting, you can see the impact of the hospitality industry. Typically, hotel and tourism industries account for up to 10% of worldwide GDP. That's pretty amazing. Okay, why invest in hotels? Again, I'm not going to read it. I'll be happy to send you this deck. What I think is interesting about this slide is that the risk column is longer than the reward column. I think the reward column could also be summarized into money and ego. I think you could make it even shorter, but we tried to make a little effort there to make it a little longer. All right, so estimates indicate that the hotel sources of investment capital are similar to the ratios to all real estate investment, with private equity accounting for 75 to 80% and public equity accounting for 20 to 25%. Kendra, I'm going to start with you. This is very basic. So can you give us a little more detail on where the money comes from for hotel deals?
Yeah, so most hotel deals, they're going to be structured with both a combination of debt and equity, which your averages for that are typically around 60% on average for the loan to value on the debt side, which leaves you with 40% on the equity side. So where does that equity come from? That equity is going to be either a public group or a private group. So on your public groups, these are groups like your real estate investment trusts. So these are publicly traded companies. Examples of that would be companies like RLJ Lodging Trust, which is one of the largest hotel REITs out there. So with that equity, it's done by shares, which then they're acquiring their hotels through those funds. On the private side, these are what a lot of us here today are. which is the direct investment groups. So Elise Capital, we're a hotel investment firm where we're raising funds through investors and going after a deal specifically. A lot of groups that you'll see here, oftentimes with the capital on the end of their name, is going to be that type of equity, which is private, and you have to have that relationship with that company in order to invest with them. On the debt side, which is the remaining 60% to close on your deal, on the public side, these would be your commercial mortgage-backed securities, also known as CMBS. So groups that you might have with this might be Starwood is one, maybe Wells Fargo, Morgan Stanley. Those types of banks often do CMBS loans, which are bonds. So that's where the publicly traded part comes in. On the private side, this could be your commercial banks like Regions banks, for example, or even still on that some of those banks as well. Wells Fargo will do regular, real estate loans. Oftentimes on the private side, that's also going to be your local community banks are what's going to be a great partner depending on the deal size. But those are where you can look to find both your public and private capital.
Great, thank you. I see there's some folks standing in the back. We have a whole sofa here, 2 chairs there. Feel free to come on in if you don't want to stand. All right, okay, or just be comfortable. Okay, so next, this is our final quiz. So how many brands does STR list globally? If you work for STR, keep your hand down. No cheating, so this is global. How many of you think it's over 250? Raise your hand. No? Okay, over 500? I've got one here. I've got a couple. All right, over 1,000. A handful. Some of you, okay. The winner is over 1,000. That's great. So actually, there are over 270 brands in the U.S. alone, and this is the global number. So in the U.S., we've got somewhere around 70% of all hotels in the U.S. are branded, and it's almost flipped that outside of the U.S. So, Chris, I'm going to head to you. Why would somebody brand? Why would somebody pick a brand and pay them all that money?
Well, I think the primary driver for selecting a brand is clearly distribution. It is getting hooked up to that reservation system and having that pipe feed reservations into your hotel. So that's your primary driver. Within that, you also have loyalty. As we all know, everyone's carrying a Marriott Bonvoy card or a World of Hyatt card or an IHG Rewards card or a Hilton Honors card or whatever, all the different brands. So that loyalty also is another driving factor. But again, it all feeds back to that distribution. Finally, the other big sizable component of it is something that Kendra was talking about is financing, the availability of financing. It is typically much easier to get a branded hotel deal financed than it is an independent. Lenders typically feel more comfortable if they know that there's brand standards that are involved, there's support to the individual hotel investor that's coming from the brands as well.
Can you give us a range? What's kind of the typical amount or percentage that an owner would pay a brand?
Yeah, sure. So you've got, if you kind of lump them all together, so royalty fees, marketing fees, chain services fees, other brand, et cetera fees, and loyalty fees, the number is somewhere between kind of 8 to 14% of rooms revenue, and that varies for a number of different factors. There are certain brands that do charge you royalty rates on your food and beverage revenue as well. That's typically higher end full service brands, as opposed to your traditional select service brands, which are just going to do everything based off of rooms revenue.
Okay. So one more question, and I'll throw it to you, but I'm open to any. Is there a case where a brand is not needed? So I think that's a great description of the value of a brand. Are there times when you don't need a brand?
Sure. I think to start back at the beginning, it all comes back to distribution and demand. Right? So if you look at markets that are very, very high volume occupancy markets, typically you may not necessarily need that brand because all of a sudden the demand is coming to you already. So do you really need to pay the brand for that system? I'll give you the easiest example I always give everyone is the Florida Keys. The market is totally constrained in terms of supply. So there's very few new supply entrants into the market. So unlike a market like Orlando, where you've got massive amounts of new supply churning through the market all the time, so you're still competing with new hotels. In the Keys, you have a relatively small market. You've got a market that's supply constrained, so the brands are less important.
Okay, great. I see a few new folks have come in. We still have some empty seats up front if anybody wants to join us up here. So there's a lot of different types of folks here at Hunter. And I think back in the day, they used to like mark on your name tag, investor, owner, consultant, blah, blah, blah. There's a lot of different types of people here. Aaron, can you walk us through kind of who all these players in this ecosystem are? And I should say that other than the bottom layer, they all want to make money, right?
Absolutely.
Okay.
I mean, this is what I love about what we do. We actually get to speak with all of these players at all times with our service of project development. So kind of going back to the beginning of this, ownership groups, you have the REITs, your private equity groups, sovereign wealth funds, a lot of different institutional owners. And then you have like public agencies. You'll be surprised that places like City of Houston, they own hotels. Georgia Airport Authority, they own hotels. Orlando Airport Authority, they own hotels. So you even have those type of public agencies, owner-operators, lenders. And so, this entire, kind of the top part, you'll see that they're all in this building. But, the hospitality industry is just so, the ecosystem is so full that we actually need other parties to even get deals done. So then you'll start going down into your third party. And so in the building here, you'll have people who are offering financing. You'll have appraisers here. And then to get that deal done, and all your different lenders. And then you'll drop down there from there. And like we talked about earlier, your brands. You'll have representation here from Hilton, IHG, Marriott, Sonesta, kind of all of the brands. And then your management companies, someone to manage that hotel for you. Sometimes brand wants to manage as well. So you have some brand manage, and then you have a lot of people in the room that self-operate as well. Some of those, some owners, they say we don't need it, for whatever market they're in. And then, you have your hard brand, soft brand, independents. And then you go all the way down as eventually, on the ownership, they'll typically have someone managing that hotel for them, offering some type of third-party service of like asset management. So sometimes, a lot of your REITs, they have it internally, but some of your private equities, sometimes they like to source outwards and get an asset manager outside of their company. Then you have your management company and then the property chain, your general manager. But then you have consultants like myself that service kind of all the ownership groups that provide project development services for your ownership groups in order to get things done for their PIPs to implement brand standards. And then you have legal, accounting, brokers. You got your architects and your designers to help the ecosystem go around. So the hotel investment system is it's so wide, diverse, and there's a spot for everyone.
I think I need to redo this slide because considering I'm with ISHC and we have 3 consultants on stage, we need our own color over there, right? Yeah. Not just off to the side. It shouldn't be an afterthought. All right, so let's talk a little bit about the real estate cycle. When we first started doing this session, the first time I did something like this many, many years ago, this was nice, and we could say, in this year, this happened, and in that year, that happened, and now that just has all gone out the window. The real estate cycle is up for grabs, but I still want to talk about it. So, JR, can you walk us through kind of the fundamentals of the real estate cycle?
Sure. So, taking a step back from it, you're going to hear terms peak, trough, and sort of going growth towards the peak and compressing from the peak down to the trough. So typically, if we start at the peak, you're going to be in a phase of rapid development. Transactions are bountiful. You have a kind of a cost of capital that makes sense, both from a return on investment and from a lending perspective. So interest rates are favorable. When in an environment where labor costs, material costs make sense to build a development deal or for an acquisition. When these fundamentals start to get a little wonky, we start to see a bit of decline in development, a slowdown in acquisitions or sort of trades, and we're sort of leading towards a trough. Consumer confidence tends to soften a little bit, spending goes down, so our occupancies, our ADRs tend to decline. Development goes hand in hand, so we see the fundamentals start to decline, and we end up more towards a trough. This is a place where development is almost stalled, so to speak, and this is where you find a lot of opportunities. If it's a land acquisition, if it's an ownership group that has to refinance and is unable to find a favorable loan and has to exit, you find a lot of financial opportunity there to be able to come in at a more favorable basis or at a position where you're able to finance an acquisition much more aggressively. As this volume starts to ramp up in the bottom of the trough, we start to see typically hand-in-hand occupancy starts to recover. With that, ADR starts to recover. Fundamentals start to make more sense from a development perspective, so you're able to find and acquire that land or acquire an existing property that might need a PIP or a renovation, and the cycle continues. You end up at that peak again, and we go through the cycle again.
That's great. All right, so do you want to talk us through this slide a little bit, kind of the history of? Anybody else want?
Happy to, yeah.
Basis.
Yeah.
So, we'll say this is the market cycle by change in RevPAR by year. And I want to give a shout out to Isaac Colazzo with STR, if he's in this room, who provided all this data. So thank you. Do you want to talk through it?
Sure. So RevPAR is, again, our top line revenue or profitability as an industry. It follows very closely with the overall real estate cycle. So you'll see 2001, 2002, we had dot-com crash. We went through a full recovery through 2000 and sort of late 7 into 8 GFC, and we saw the declines again. So they follow hand in hand, going through sort of 2010 through the beginning of the pandemic. We had a relatively stable growth cycle, slightly downward trending towards the end, but a lot of that, in my opinion, was driven by a capital environment that was really favorable. So really low interest rates during that period kept us very consistent as an industry. And of course, the dramatic end is through the pandemic. We saw a massive decline in RevPAR as a whole, and then a massive recovery afterwards. And now coming into 23, 24, we're sort of coming back to an equilibrium. So volatility at its finest in the last 4 years, but we're finding our balance again as an industry.
Yeah. I'm an optimistic person. I love the idea that it always comes back, right? The real estate cycle, it does go down and you get that feeling in your stomach, and then it's going to come back. All right, we're going to pause here for questions, and I'm going to start on this side of the room since you've had to see our backs. So any questions on anything we've covered so far? No? Okay, we've got a question right over here. Where do you think we are in the cycle right now? I love that question. I didn't even plant that. So I'm going to go back.
Yeah, we want to click back.
Yep, I'm going to go back. Here we go. And Aaron, let's start with you. Where do you think we are?
I think we are at that occupancy kind of recovery stage. We're trying to get back to, a lot of people say we're already back to COVID numbers. We operate in tertiary markets, so in the Southeast, that's where our hotels are. So our recovery was a lot faster than a lot of the bigger markets. So I think, my fellows here can probably speak definitely to the bigger markets, but, here in the Southeast, like we're in Birmingham, Alabama, we are seeing, things climb back. We saw things climb back a lot faster. I'll pass it to JR because I know you're in Chicago, so.
So we operate nationwide, own and operate nationwide. I'm a little more pessimistic. I would say we still haven't hit the bottom. We heard the Fed talk about, and we've all heard, soft landing, economic soft landing. And I think we're still heading towards that. The catalyst for us is really cost of capital. So interest rates are still at an elevated level, and with an unknown future of where they're going to land or when a potential increase or decrease might come, I still think there's some more pain in the market to come, and we're going to start to see more opportunities. We're seeing on an acquisitions front, bid-ask spreads starting to close, the delta is tightening up, so deal transaction volume is going to start to pick up, and as that does, I think we'll start to see recovery. But I'm a bit of a pessimist, so I apologize.
All right, Kendra.
I'm not that pessimistic, but but I do think that this market's recovery is not as simple as they used to be because we have so many factors now with interest rates rising, but also inflation rising much faster than it did in prior markets. And because of that, this cycle this time is actually a little bit flip-flopped. So in the case right now, based on the STAR report for 2023 nationwide, ADR has recovered. A lot of that is because of how much inflation spiked. So in this case, where in the cycle, typically its occupancy comes back, and then because that demand is built back up, then your rates are able to soar. The cycle is flipped this time. Occupancy is not fully back. It's pretty close to being back, but it isn't all the way there. But ADR has fully been back to our 2019 peaks, which is why RevPAR right now is higher than it was in 2019. But then when you couple in the interest rates right now, it's making that cost of capital a little bit harder to get a development deal done. So right now I would say that we're in the ADR recovery, occupancy is almost there, and development still has some time to grow.
All right, Chris, what do you think?
I hate to be a consultant here, but I think it depends on the market that you're in. I mean, to Erin's point, you look at Southeast, particularly in Florida. Florida's probably almost gone through a full real estate cycle in the last 2 years, just with the amount of demand that came in, and now things have come back down. But to Kendra's point, I think it's really hard to say where we are because of the impact of inflation, not necessarily as well as financing, but the inflationary pressures that we've seen on the expense side on the hotel operations are tremendous. While we're seeing huge ADR growth, which is fantastic and has really helped take some of the pain away from what happened during the pandemic. At the same time, your cost of labor, your cost of goods, everything has gone up. In many ways, we should almost be adjusting this cycle to be looking at GOPAR going forward as opposed to just top line, because it really is changing dramatically where you think you are in the cycle. Because if you look at your top line, you're saying, we're doing great, we're doing fantastic, but you look at your bottom line, in many cases, you're still trailing 2019.
All right, so I'm going to put you on the spot, Chris. 10-second definition, what is GOPAR?
Gross operating profit per available room.
All right,
Thanks.
okay. Any other questions? We're going to have a few more stops for questions. Anything on that? Okay. All right, here we go. Chris, we're going to stick with you for a minute. Tell us what a cap rate is, how to use it, cap rate 101.
Okay, very quickly, it's the rate of return you expect to earn on a piece of commercial real estate. So Andrea's put together a very quick formula here so everyone can see what it is. The key element for cap rates, and this is one of the items that's impacting the real estate cycle right now, is cap rates have increased pretty dramatically to reflect the risk that we are seeing within the marketplace, but also the risk that we're seeing with the interest rates that we're seeing as well. So it's very simple. You've got an example on the next slide that I think is even easier for everyone to understand. It's basically you're taking your net operating income and you're dividing it by the cap rate, and that gets you your value of the asset. Or in this case, she's got two examples, a selling price and kind of a buying price. And so effectively, the higher the cap rate, the lower the value. The lower the cap rate, the higher the value. Cap rates are also not stagnant across the industry itself. They vary by sector. So typically your higher end properties, your luxury hotels are going to have lower cap rates, and then your select service hotels have higher cap rates. And in general, the cap rates that we're looking at, I mean, it depends market to market again, but it can range anywhere from kind of 5 to 11. Right? So there's a wide range here. And the other thing to keep in mind as it relates to cap rates, specific to the overall commercial hotel market or the overall commercial real estate market, is that hotels have historically always had the highest cap rates because we're considered the riskiest asset class. Although things are changing now with COVID. So office is no longer the safest place to be, and multifamily is starting to see some chinks in their armor as well, so they might start to see higher cap rates that are closer to hotels. But typically, those asset classes have always historically had lower cap rates.
Great. Talk through that guy.
Yeah, so again, this one's, and I might rely on JR on this one too, but it's a little different than it used to be. But historically, if you were in a recession, you would have a higher cap rate. And then as you were recovering, your cap rates would kind of stabilize. And then as you started to grow, your cap rates would go down. Basically, there were more and more people out there looking to buy more and more assets. So you could price your asset more aggressively. And then when you got to the peak, it would start to level off again. But JR, you got anything? Has that changed in terms of with financing?
I think fundamentally you're spot on. What we're seeing also, to your point, is market by market. You may have markets that saw a massive flood of occupancy over the last 3 or 4 years, and you have a seller that's looking to exit. Well, their cap rate's going to be far more aggressive than it's typical select serve in the Southeast. So it's very much skewed. We don't have it's not a level playing field across the board. It's really driven by market, what the barriers to entry are on those markets, and it's changing a little bit.
Great. All right, I'm going to pause again. We typically, gosh, and there's so many people back here. As someone in hospitality, this makes me nervous, guys. I'm sweating. There's lots of empty chairs. Come on in. We have 20 more minutes. All right, so any questions on cap rates, the real estate cycle? You guys are so good. They don't even have questions. You've answered everything. This is amazing. No? Chuck, you don't have a question? You always have a question. No? We'll save it. Perfectly. All right.
He has a question, I think.
Oh, you see one? Oh, hi. What's your question? All right, did you get that? So you had said that luxury properties have lower cap rates. So let's say if you've got a cap rate at 5, how are new owners capitalizing? Is that the gist of it? How are the buyers putting together the capital stack? Is that what you said? Yeah, something like that?
How are they getting a deal done? It sounded like.
Yeah.
Your interest rates are north. So how are people making money with cap rates like that and interest rates where they are? Is that the gist of it? Like, how are you turning a profit?
Well, I'll just say very quickly, there's very few transactions right now because of the interest rate market, and I'm going to let JR speak to it and Kendra speak to it because they're obviously out actively looking for properties to acquire.
Yeah, so transaction volume, especially in the luxury space, is down. One, because it's going to be very hard to get lending on it. So you're putting in much more equity for those types of deals than you would have before. And to your point, it's oftentimes not worth it. So that's why the transaction volume is very low. And it also goes back to Andrea's first slide and, what is your reason for investing, which oftentimes on the luxury side, it might be that egotistical part. And in that case, then, you're holding that for a long term and you're waiting for the market cycle to finish and that property value to appreciate, in which for a luxury hotel, it should. So that's the rhyme or reason to how people are getting those types of deals done. But again, right now, the luxury transaction market is very slow because of the inability to get debt on it.
Yeah, and I think if you were to take a snapshot in time and say it's really a cost of capital issue today, so you may have partners who are looking for X rate of return that the deal doesn't make sense at, or it's able to give you that rate of return, but you're competing against a CD and a bank. There may be buyers out there or partners out there who are willing to come into a transaction because they see a capital event in the future, be it a refinance, be it a recapitalization, new partners coming in, or an exit. So you may have in a snapshot today a lower compressed rate of return, but at some point in that investment life cycle, you will recoup it. It's just a matter of, can you get it to pen today, and can you get it to pen for whatever your reversion or your exit is on your modeling? Is it year 5, year 7, year 10, or forever? But at some point, a capital event could actually bring you back square and make a favorable return on investment for the market.
Got it. Good question. So the ego that Kendra was talking about, I've heard that referred to as ROE, return on ego, instead of return on investment. All right. What other questions do we have? This side? No? Nobody? All right. Okay. We'll keep going then. Oh, we got a question. Oh, we do. I can't see it. Oh, hi. Okay. Here we go.
Based on the numbers for your 2050 projections, it seems that the amount of hotel rooms available is going to be increasing at a rate double the population growth. At a certain level, the saturation meets your calculus for investments.
Got it. Did you guys? So based on projections of number of hotel rooms coming into the market, it's more than double the growth in population, projected growth in population. So are we worried about saturation? So those of you that are budgeting and planning and doing projections, how are you looking at growth in supply versus growth in population?
I mean, so for my assets and when I'm looking at an acquisition, I'm not projecting very high year-over-year growth in terms of occupancy. What I am assuming is that these hotels are being built for a reason. And so with that hotel supply increasing, I'm expecting that demand is going to increase as well. So perhaps I'm not getting that same occupancy because now people have more places to go, but there's something of value in the market now, and that's why our rate can continue to increase. So typically for my hotels, I'm very conservative in my projections. So I'll be projecting occupancy for only 1 or 2 years because we know new supply is inevitable. But that rate growth will continue throughout the hold period.
I think, if I recall, that slide is global hotels, correct? I think it's global hotels.
Yeah.
I mean, ultimately, the hotel business is still a street corner business, right? So you're looking within your own market to identify the individual supply growth within that individual submarket, and that's the real key to focus there. Because I think if you look at this global growth, a lot of it has to do with global expansion outside of, let's say, already developed nations. So you've got other parts of the world that are still rapidly expanding and growing, and developing new hotel supply, whereas if we're looking in the United States, we're actually right now we're at one of the lowest points of percentage growth in supply, I think since STARS kept records, because of this capital issue that we have right now.
I think one entire of those whole buildings is what's happening in Saudi Arabia, is my guess. What they're doing is unbelievable. Any other thoughts on this, on global hotel rooms? All right, any more questions? And I'll try to see a little. One more question? No? All right.
What do you think they're going to make some adjustments on interest rates going forward? Just based off your knowledge.
Yeah, all right. So I feel like we're going to hear a lot about this in the conference, but let's do kind of a speed round. When do you think we're going to see a change in interest rates? I'm assuming that's a decrease, yeah. When do you think we're going to see a change in the interest rates? Speed round, Aaron, we'll start with you.
I have no clue, guys.
I like the honesty. Thank you.
Personally, I think Q4 this year, Q1 next year wouldn't be an unrealistic timeline, but there are challenges, there are headwinds that we're seeing. Inflationary pressure continues, is starting to moderate. There's a lot of factors, but if you ask my 2 cents, I'd say Q4 this year, Q1 next year, we'll start to see some movement.
Yep.
Yeah, I think it depends on the loan type. So for some CMBS, I have been seeing that go down a bit in comparison to how high it was last year, but not down enough. So I agree that not until the end of this year going into next year, also with it being an election year, we know that puts things on pause for a little bit. So kind of more so Q1, Q2 of next year.
All right.
Yeah, I agree. I think it's a post-election, before we start to see material changes.
Okay. So we've covered a lot of basics here. Let's put some of it together. So you've got a potential deal, Aaron. You're looking at it. What are you looking for to decide? What are kind of your decision-making factors?
Yeah, location, and really going back to the first slide, why are you investing? And then when you figure out why you're investing, you have to figure out where you want to invest and how that, how does that operate within your model? So location, and then there's an expected return with that location that you're investing in. And then, trying to determine really your thresholds for demand and ADR and understanding the RevPAR of the market, making sure you're understanding where you need to be with interest rates, as we talked about a lot. And then what's supply? Are you doing a new build? Are you purchasing an existing asset? Is there more hotels coming in the market? What's the demand look like for from the outside as well, that could to raise that room supply, because you just never know. Other income streams, if you're full service, if F&B outlets, if you're select service, what does your market and things look like? Can you get an alcohol license to improve those other income streams? Branding and distribution. As we talked about earlier, your brands, they're going to bring a certain loyalty there and distribution, but you might not need a brand. So just understanding that as well. Other operating costs too, like taxes, that's huge. As we've seen the value increase, your taxes increase, and so some of those things you can plan for and some things you can't. And ongoing CapEx, just with equity, making sure you're doing your due diligence at the beginning of your deals, making sure you doing roof assessments and MEP assessments, and then understanding what the brand is looking for from a PIP standpoint, and what the expectation is there. I think that is, that'll get you a good base and foundation so you can have proper underwriting.
Great. You mentioned CapEx. Oh, sorry. You mentioned CapEx. You want to walk us through a little bit about the CapEx cycle?
Yeah. So, at the end of the day, the longer the building is around, there's an injection of CapEx that's needed. Along with, in the hotel business, there's different thresholds for CapEx that has to happen. There could be there's a 7-year with some brands, there's a 10, and then there's a 14-year, and there's a 20-year. But the longer you have the asset, there's an influx of capital that's going to get, so as you see like year 8 and 9, there's a full renovation cycle that ends up happening. Full renovation typically means case goods, soft goods, all of your public areas as well. When you get to that 14, I think it's Hilton, they require you to do your exterior as well. And you really have to understand what that cost is. For a while, I hope there's no Marriott people in here, but for a while there was a big thing. For a while there was a big thing with courtyard. A lot of owners were having a tough time with the courtyard renovation, where they were doing a whole new facade and things like that, and it kind of caught a few owners off guard. And so there's a big fuss about it. So you have to really understand what that demand is by the brand when you are talking about your capital spend, because the longer that you have the asset, the more capital influx is going to happen, because things do break, right? Things do happen. So as you get into that, past that 14-year, you start getting that red zone, and you really got to be cautious of the asset. So, kind of back when we were just talking about, what are you looking for in an asset? Make sure you understand the building age. What does it look like? A lot of people are into, revitalizing older buildings right now. That comes with a lot of pressure.
Great. All right, so we're running short of time, so we'll do this quick. So Kendra, we have used Aaron's checklist. We've looked at CapEx, we found a deal. This is our deal, we feel good about it, it's an existing property. Walk us through how that money comes together.
Yeah, so we found our existing property, very exciting. How that money is going to come together is also going to depend on a couple of things. One of those things is going to be, what do you need? So as Aaron just mentioned, in the capital cycle, if you need a PIP or a very large renovation, you might be looking at a construction loan, which is going to be possibly a different capital structure than just a straight cash flowing acquisition. So your project type is going to determine how much in terms of debt you can actually receive. So with this 60 to 70% loan to value that we're using as an example, if you have a strong existing branded cash flowing asset, you're probably getting closer to that 70%. Whereas if you have to go through a full renovation cycle or changing brands, or depending on the age of the hotel, or if you just don't have the cash flows to support your debt service, you're going to be lower on that 60%. So that piece is just all for the lender in how comfortable do they feel that you're able to pay your loan back. So once you figure that larger piece out of where's the debt coming from and how much, you can then fill the remainder of the gap. So in some cases that might be mezzanine financing, which would be more of a in-between level of both the debt and equity, and can come in as a piece, usually as the last piece to help you close the deal if you don't reach that equity funding. But the largest piece and most traditional is just going to be the straight equity, which we had mentioned in the beginning. For most of you, if you're going to be an owner or a developer, that's going to be going to your network. So friends and family, doing a syndication or pooling funds as a full investment fund. Those high net worth individuals, family office is a very great equity source to be getting these larger deals done.
Great. So JR, same question, but now we found just a piece of property that we love, and we want to build a whole new property. Where does the money come from that? How is it different?
Oof, building hotels today. Similar structures, so high net worth individuals, family office, or private equity, or private capital coming from your own checking or banking account. You're typically leverage point from a debt perspective in this environment, if it's available, if the site makes sense, call it 50, maybe 55%. But again, deal driven. So if you have a phenomenal market, maybe it's high barriers, you're able to get a piece of dirt that is entitled, or you complete the entitlement and zoning process. You're able to identify a really great brand partner, and the market fundamentals are strong, both from an occupancy perspective, but an ADR perspective. Very similar approach as an acquisition. What you're going to see on the debt side is typical construction loans. So anytime we're in that position, we tend to lean towards what is called a mini perm. So it's 5-year piece of debt that's maybe 2 years of interest only up front, that gives you interest only payments to get through the development portion and a portion of your ramp up, which upon receiving a CO or certificate of occupancy, it converts to a permanent loan. And so that gives us the stability coming out of construction through ramp up, that you don't have a position where you have a completed property without revenue coming in, and now you're having to get a piece of permanent debt without any revenue. And the appraisal is probably not, in this market, is probably not going to come out very well, and you might be stuck with a brand new hotel that's underwater on paper. So we tend to lean towards that type of debt structure. From an equity perspective, you're really having to price in the carry through the construction portion of it and the ramp-up portion of it. So it can become costly. We're seeing a huge influx of mezzanine being structured as preferred equity right now. Pref is very, very available in the market, really to act as additional high-price leverage. So if you're only getting 50, 55% of debt, and you're able to bring in a preferred equity slug at a higher cost of capital, that can maybe make your deal pen. And again, short-lived, generally short-lived, to be able to get through our kind of lower part of our cycle right now to get you out of development and towards a ramp.
Great. All right, we have time for one question, maybe two. I see one over here. No, you were stretching. Sorry. No more questions? Okay, please join me in thanking our panelists. Appreciate you all coming. Thank you.
Good job, guys.
All right, I'm gonna get a picture real quick.